Oil prices have remained relatively unchanged since the start of the week, showing some signs of stabilization. In today's report, we are going to have a look at the data relating to the US oil market and continue to view the fundamentals surrounding the international oil market. To conclude the report, we will also provide a technical analysis of WTI's daily chart. The data on the ground of the US oil market tend to be quite telling for the course of oil in the States in the past week. We make a start with the Baker Hughes oil rig count that showed that the number of active oil rigs in the US dropped by 1 to 478. The release may imply that some weakness in oil demand persists as the number of active oil rigs remains low. However, the API weekly crude oil inventories figure reported a substantial drawdown of minus 4.44 million barrels if compared to the prior reading of indicator of roughly minus 1.9 million barrels. The release implied that the US oil market remains tight as demand levels exceeded the cumulative oil production. Similarly, the AI also confirmed the tightness of the US oil market as it reported a drawdown of minus 4.87 million barrels, which was higher than the prior week's drawdown of roughly minus 3.44 million barrels, yet confirms that oil production did not satisfy the demand of the US oil market. Overall, the data seems to align that the tightness of the US oil market may have increased. As such, should we see additional data implying that the US oil market remains tight in the coming week, we may see oil prices getting some support. China's GDP rate for quarter 2 came in lower than expected at 4.7% on a year-on-year level and 0.7% on a quarter-on-quarter basis. The lower than expected growth rate may be a cause for concern as a slowdown in economic growth for the largest oil importer in the world may imply that demand for oil may be also decrease in the future. Therefore, the implications of oil demand from China decreasing in the future may have capped the potential price gains for crude oil during the week. However, it should be said that China's industrial production rate for June came in higher than expected at 5.3% versus the expected rate of 4.9%, which could insinuate that demand for oil from China industrial sector may not be on the decline just yet. In turn, the release may alleviate some concerns at least on a short-term basis in regards to oil demand stemming from China. Nonetheless, should further financial releases stemming from China imply that economic activity may be slowing down, it could weigh on oil prices and vice versa. According to a report by Reuters, the Kuwait Petroleum Corporation stated this Sunday that it has made a giant oil discovery in the Al Nokafa field, with oil reserves estimated at 3.2 billion barrels. The recent discovery made by Kuwait could potentially weigh on oil prices, as should Kuwait explode their newly discovered oil reserves, it could increase the supply of oil into the market, which in turn may have a negative impact on oil prices should supply exceed demand. However, the development and extraction of oil may not be immediate, as an impact on oil prices may occur at a later point in time. WTI's price appears to have stabilized during this week, with the commodities price remaining between the 79.60 support level and the 83.45 resistance line. We maintain a sideways bias for the commodities price, and supporting our case is the narrowing of the Bollinger Bands, which may imply low market volatility, in addition to the RSI indicator below our chart, which currently registers a figure near 50, implying a neutral market sentiment. For our sideways bias to continue, we would require the commodity to remain confined between the sideways moving channel defined by the 79.60 support level and the 83.45 resistance line. On the flip side, for a bullish outlook, we would require a clear break above the 83.45 resistance line, with the next possible target for the bulls being the 86.95 resistance level. Lastly, for a bearish outlook, we would require a clear break below the 79.60 support level, with the next possible target for the bears being the 76.05 support line. That wraps up our top financial stories for this hour. Thank you for staying updated with Iron FX. We wish you